today we're going to finish cost allocation. We're going to finish up with activity-based costing, and then departmental and joint product costing we'll talk about. We'll definitely get the cost leading to decision making, which is chapter 9, profit planning, DVP analysis. And well, I thought we'd wait till the end of the semester to do the cost estimation. We'll do a very small part of the year. And if we get lucky, we'll start on the master plan, which is actually a 40 English test. Okay, so we talked about activity-based costing a little bit. I remember somebody was eating more than they should have been lunch or something. Ordered pizzas. Pizza. And I think this is where we let off, which is a very complicated problem. Let's just give us a test, a sense. Now we're going to go to a bit more complicated problem. Remember, there's volume-based costing, which is kind of the way it's historically been, where you find a volume driver like direct labor hours, and you allocate overhead, factory overhead, based upon that driver, direct labor hours. Particularly in the recent past, as there's more of a move towards automation, the use of direct labor hours as a driver for overhead becomes less relevant because automation makes labor less relevant. And there's been a move towards activity-based costing, which is let's understand the activities at a detailed level, from almost an industrial engineering perspective that it takes to complete a product. And let's understand how to allocate our overhead based upon each of those activities, like batch setups, things like that. Okay, so let's go through an example of using volume-based versus activity-based costing. This comes from our textbook. HBT sells 2 products, AW and SZ, and they have these as kind of some of the basic information, sales information for each of those products. AW is a high-end, low-volume product. SZ is a product that they would sell in higher volume at a lower cost price point. So you can see they produce a lot less AW than SZ. They charge twice as much for the product. Direct materials and labor costs. The direct labor hours, 25,000 versus 75,000 for a total of 100,000 direct labor hours being used. And the direct labor hours per unit is simply 25,000 divided by the number of units sold, the volume. Okay, so this is information we have about them. If you did your cost allocation via the volume-based approach, and here's how you do it. You would assign the overhead based upon direct labor hours, as we talked about. Another given is that their total overhead turned out to be $2 million. And we said there were a total of 100,000 hours of direct labor, so $20 per hour is their allocation of overhead. So that's $20 per direct labor hour. Using that as your allocation, we know that AW used 25,000 of the 100,000 direct labor hours to make their 5,000 units. And so that would be 25,000 direct labor hours times $20 per hour. $500,000 would go to them, or $100 per unit. So 5,000. So they would be allocated $100 per unit. And Unfortunately, their lower-end product used 75,000 direct labor hours to make 20,000 units. Going through the same math, they'd be allocated $75 per unit. So $100 per unit for AEW and $75 per unit for FZ. And you can then look at the profitability of each product. We know they sold AW for $400 and FZ for $200. We were given the $200, $80 direct costs, and we just determined the overhead using the volume-based method. So both products made a profit. AW made 100 and FZ made 45. Which product should they focus on? AW, right? They have the profit margin is better for AW. $100 versus 45. So using a volume-based approach in this example, AW is the more profitable product for them. But they decided to do it with an activity-based approach. And remember, the first step of activity, or ABC, activity-based costing, is to do an activity analysis and understand what needs to be done to get these products out the door. And they came up with 4 activities: engineering, setup, machine runtime, and packing. Now, the total overhead has got to be the same in both cases, whether it's activity-based or volume-based. That $2 million that was allocated on the volume basis is the same $2 million here. But they determined through their activity analysis that engineering was $125,000, set up $300,000, machine running was the vast majority of it, $1.5 million, and packing was $75,000. And then for each of these activities, they determined what would be the appropriate cost driver. Machine runtime, machine hours make sense. Setups, the number of setups. Engineering would be hours of engineering, and the number of packing orders. Without really going through the details, what do we think between the two products? Do you think either product might have like more usage or disproportional use of some of these functions?
Like the high volume product would need more machine running time.
It would need more machine running time, for sure. Anything else?
Would need more engineering hours too, probably. The high volume.
Because they sell I think it was 4 times as much. They'll probably need more of everything.
Mm-hmm.
But how about proportionally? Does it need 4 times as much of these things?
Packing.
And probably, packing's probably that would have that 4-to-1 ratio. But you need the package for both nice. You might have glossier packaging for the AW. How about setups? Anyone have a point of view on setups?
I think maybe low volume of more. Because when you're doing high volume things, you just run it. So at once you go all day. I guess if they're doing higher end products, you're going to push stuff.
Right, I think that's probably right. If you're doing a higher end product, maybe it's some customization that goes on, and you have to set up the machines a few more times for the high end product. Engineering, what do we think there? Probably disproportionate for the high end. So you start to see that when you break it down by activity, that a high end product maybe uses resources proportionally more than a higher volume product. Possibly, and in this case they do. That's the case we show. So they actually completed the analysis and showed that for engineering, for instance, 5,000 to 7,500 hours of engineering clearly not the 4 to 1 or 2 to 1 product. How many products do you sell? I don't want to just make them up.
3 to 1.
3 to 1?
1.5 and 75.
4 to 1.
Oh, it is
4 to 1. Machine setups 2 to 1. Even machine hours only. Machine setups 2 to 1 in the opposite direction actually. AW had twice as many setups. Machine hours 2 to 1. And number of orders 2 to 1. So clearly not the 4 to 1 volume that we saw. So just as we figured out using direct labor hours, a rate for direct labor hours, you would figure out a rate for each of these activities based on the total cost, the total number of units of whatever the driver was, and so that would give you a cost per unit. $10 per engineering hour, $1,000 per setup, $10 per machine hour, and $5 per order, per order. Okay, so you now have a rate by activity that you're working with. And you can then find out the cost for each of the two products, the overhead. So at 5,000 units, you would take the rate times the amount of consumption that each product has for each of the activities and determines the total overhead cost. So AW, the high-end product, had $775,000 of costs, and they were allocated $155 per unit. Not a surprise. Generally, high-end and low-volume products take a disproportionate amount of resources to be completed. And so high-volume products tend to pay for the high cost, for the high-end product. We did the same thing for SD, and their overhead was $61.25. And as you expect, the total overhead still has to be $2 million. That doesn't change. So the $725,000 and the $1.25 million add up. And you see now, and this, this is an example made to make a point, using activity-based costing, we now show that AW is not as profitable as the high-volume product. So the advantage of activity-based costing, digging in at a detail level, understanding the cost components, allow you to allocate overhead more appropriately and maybe make a different business decision. In this case, the business decision is to try to sell more of the SD. And so the concept of product cross-subsidization says that you tend to overcost high-volume products, and they tend to subsidize the low-volume, high-end products. Okay, so what are some of the benefits of ABC? Get better profitability analysis, and therefore you make better decisions. One of the side benefits of ABC, I'll talk about it in a moment, is activity-based management. Because you're looking at your business at a detailed level, you start to understand what are your value-added activities, what are your non-value-added activities, which activities are costing too much, which ones do you possibly want to outsource. So you can use the activity-based costing process to better understand your company and therefore cut your costs even more. So you can do business process improvement through that analysis. Of course, course, you improve your cost estimation. And as we'll talk about now, the cost of unused capacity. Remember in the in the example we just did, we said that there were 12,500 hours of engineering time used. Just remember that. In fact, the engineering department had 15,625 hours of practical capacity. Practical capacity. That does not mean you count up all your people, take 40 hours a week, and figure out how many hours you have. Practical capacity is how much real capacity you have when you factor in training, vacations, sick time, other activities maybe away from engineering that people do. So that 15,625 is a true and practical understanding of how much time was available in the engineering department. Accounting firms live by practical capacity. How they determine billing rates, and everybody who works in the accounting firm, whether it's a junior staff person to a partner, is expected to have a certain amount of time at clients and a certain amount of time doing other things, whether it's training or internal projects or whatever else it might be. So practical capacity is a very important concept. But in this case, so you use the practical capacity, and if you thought about the full rate here, rather than $10 per engineering hour, it would be $8 per engineering hour as overhead allocation. So you instead of allocating at $10 an hour those engineering units, you would allocate them at $8 an hour. And that's more fair, right? Because just because engineering is overstaffed, should the product managers have to absorb the cost? Should the product managers be evaluated based upon the fact that engineering is overstaffed, which is what you're saying here? They should have only had, they don't need $15,000 of practical, 15,000 hours of practical capacity. Yes.
HPD stands for what? What is HPD?
Oh, some made-up company. Haymarket Biotech. So the costs would be less, and you would then be able to determine the cost of unused capacity and make a decision what you want to do about that. So rather than automatically put the total cost of the engineering department and allocate it, you only allocate out what was used. And let the manager of the engineering department have to figure out the rest. In this case, $25,000. So ABC allows you to do an analysis like this. Okay, activity-based management. I think we talked about. So during the activity analysis phase, you assess what activities there are and what value they bring to the customer. You then determine which ones bring value. You eliminate activities that add little or no value. We'll talk also about outsourcing. You might outsource them. You might develop an industry utility. That's done in the financial services industry quite a bit, for those of you who want to look at another topic, where the industry players say, hey, we're doing, every company in the financial services industry has to look at something called corporate actions, a stock split, merger. Things change in the way that companies are valued. all doing it exactly the same way, get together and say, hey, why don't we all just build an external company to do this for us, share the cost rather than everyone doing it together. That would be an industry utility. No one's getting a value added. No one's getting a unique competitive advantage by doing that. It's, so you do it better and cheaper within the industry. So there are ways to eliminate or outsource or utilize low value added activities. So what defines a high value added activity? I think these are pretty straightforward. It's necessary to satisfy your customers. It's necessary to make your product. You need it to make a product. I think this says the first one again. And then just critical steps. You can't get to step 3 without doing step 2 somewhere. And low value products can be eliminated without affecting the end game. Okay, let's kind of take a shift now from activity-based analysis to customer profitability analysis, which is just the exact same thing as activity-based analysis, except rather than the end game being how much does this product cost, it's really what's the value of your customer relationship. So instead of adding everything up so you get to a customer, or get to a product, you add everything up so you understand, is this a profitable customer or not? And things that could make a customer maybe less profitable than others, they change their orders quite frequently. So they're costing you to change. They do a lot of small orders. Maybe you have to do a setup for every time they call to do something, and small order processing. They require special packaging or anything special really. They have demands of expedited service. Frequent orders in small quantities, these two are related. So there are a variety of things that can make a customer less profitable. Two customers both order 1,000 widgets. One could be more profitable than the other by the way they do business. So the idea of customer profitability analysis is understanding from a customer perspective, are they a profitable customer? And if you do it right, you can understand, you can answer some of these questions. What is the growth potential of the customer? What is its cross-selling potential? What are possible reactions to the customer if you change the terms of arrangement? So as you're doing your customer profitability analysis and you realize, you know what, they're not that profitable, we have to change the way we do business, you want to make sure you understand the implication of that change. Maybe you don't want to lose them, and you're willing to have them be less profitable. And how important is the customer to future sales? So the first step is the customer cost analysis, which is kind of very much the same as the first step in activity-based costing. You look at your customers and say, what are the activities that we're performing for that customer? And they come in 5 flavors. Remember, for activity-based costing, they were product-based, batch, facility, or unit-based. Here we have 5. The first one is customer unit level costs. So examples of those, for every unit sold is a cost. Maybe a sales commission. You pay a salesperson for every unit sold. Then you have batch level costs. So for each order or sales transaction, there's certain costs. Could be setups. Could be the cost of sending out invoices for that order. Whatever, those would be unit level. Could be setups in the manufacturing environment. Customer sustaining costs. These are costs that are associated with just servicing the customer, irregardless of whether they just ordered a unit or not. And these would be, the easiest one to think about is statement channel costs. Clearly, an example of a distribution channel cost would be for Walmart. You have to put together warehouses near their locations where they want you to have warehouses, because they want you to hold your inventory for them. And so there's a cost. Now, Walmart's probably worth it, but that's a cost you need to understand when you're saying, is Walmart really worth the business? Sales sustaining costs are costs that are bigger than any one customer, and it can be marketing and things of that nature. So these would have to be clearly allocated. So I won't go through each one of these, and we're not going to do an example with customer profitability analysis, but it'll feel very much like the example that we did for ABC, with just a different name. You look at the detailed activities, and you figure out what their drivers are, and then you figure out the cost per unit of the driver. And then as you understand for that customer how many units were required, you determine the total cost of that customer. And you know what? I've never really seen this. It's in the book. I've never seen this in action. But you can find the net present value of your future profits for the customer, CLV. And I guess if you added up all of the net present values of the future profits from all of your customers, that's the value of your company. Just cutting the value in a different way. Never actually seen it done.
So how would they allocate something like distribution cost and sales sustaining costs? Would it be based on the volume of products they sell them, or be the number of orders? I hope in this previous slide you don't have any for distribution channel sales sustaining.
So the cost for a specific warehouse,
Yeah.
for instance,
Yeah. And how do they allocate that to customers?
It would be based upon some volume-based driver, I would imagine. Volume of sales. Okay, so why don't we do a short breakout here?